Realty Income Corporation has now outperformed the S&P 500 by a wide margin year to date. Look at this. Year to date, the stock is up about 9.38%, and if we look at the S&P 500, it's already down 12%. And keep in mind, this doesn't even account for dividends, meaning in reality, Realty Income has outperformed by even more. Now, with that being said, there's still two major concerns that a lot of bearish people have about Realty Income right now. One of them is going to be what will be the impact of tariffs on Realty Income's tenants, and then we have the concern of the US 10-year Treasury being significantly higher than we saw just a few years ago. So we need to touch on all of this in the video, as well as calculate the intrinsic value of Realty Income. So let's go ahead and jump into it. Now, if you're not familiar with this stock, Realty Income is one of the most popular REITs out there for a couple of different reasons. To start off, the REIT has a pretty nice starting dividend yield. Right now, it's sitting at about 5.52%, so relatively high. But this is also a company that's known as the monthly dividend stock. If we look at the dividend history, we can see they've been paying out monthly dividends for many years, around 27 consecutive years. And they don't only grow those dividends every year, they grow them every single quarter. So if we look at that dividend history and look at the dividend growth, we can see the 3-year dividend CAGR at about 3.8%, the 5 and 10-year close to about 3.5 to 4%. So this is a great combination of a high starting dividend yield, pretty solid dividend growth rate for a REIT, a great history of paying out those dividends consistently, and then of course, if we look at the dividend safety, of course, we're talking about a real estate investment trust. So we want to look at the AFFO payout ratio, and we can see it's sitting about 75.53%, which is a pretty healthy range for a real estate investment trust. So historically speaking, from a dividend perspective, there's a lot to like about this REIT. But with that being said, REITs have certainly underperformed over the last 3 to 5 years. If we look at the past 5 years, Realty Income is only up about 17.21%. Now, keep in mind that doesn't include dividends, so it would be quite a bit higher, but that's still way underperforming the market. Now, why is that the case over the last 5 years? Well, again, it has to do with the US 10-year Treasury. If we look at this charted out over the last 5 years, look how low the US 10-year Treasury was from around 2020, 2021, and 2022. When rates were this low, investors were looking for places to get relatively safe high yields. And during that time, real estate investment trusts like Realty Income were a great place to put your money if you're looking for a relatively safe high yield. But look what happened in the following few years. Rates climbed up significantly higher. And because of that, real estate investment trusts became quite a bit less attractive. A lot of investors began to think to themselves, why would I buy a REIT that has a starting yield of about 5.52% if I can get a risk-free 4.35%? Now, there's a few different reasons to think about that. To start off, that yield is still higher and those dividend payments would grow over time, but still, you can see why very risk-averse investors would start to choose these risk-free investments. And because of this, Realty Income share price really struggled over the last 2 to 3 years. Now, when it comes to the current 10-year Treasury, there's two different ways of thinking about it. Number one, tariffs make imported goods more expensive, and higher prices could prompt the Federal Reserve to keep interest rates at an elevated level to curb cost inflation. So that'd be a scenario that's not really great news for Realty Income. But on the other hand, tariffs could slow demand and restrict economic growth, which may cause the Fed to support the economy by reducing interest rates. This would be a great situation for Realty Income. This would likely cause the 10-year Treasury to go down, and that starting dividend yield for Realty Income would start to become quite a bit more attractive for a lot of investors, and they'd buy in, and it would push the share price higher. But then we have the news of tariffs. There are many companies that tariffs can directly impact, but most companies are going to be at least indirectly impacted, and I think Realty Income would fall under that category. How would Realty Income be impacted? Even though President Trump announced he adjusted his plan by lowering tariffs to 10% on most countries for the next 90 days, while increasing the tariffs on China to a whopping 25%, Bloomberg did note that the overall impact on the US economy should be fairly similar, given that the average US tariff rate only dropped a few percentage points, and people who are bearish tend to believe that this will cause problems for Realty Income's tenants. Now, why do they believe this? Well, if we jump over to their investors presentation, let's pay close attention to some of their largest tenants. We have companies like Dollar General, Walgreens, and Dollar Tree. Each of these three companies are companies that are certainly going to be hurt by tariffs. Now the question is, will this impact them to the degree that they struggle to make their rent payments to Realty Income? While Dollar General has certainly struggled over the last few years, I don't think they're so far gone that they can't make rent payments. At least not unless the tariffs end up being around for many years to come. I think the same is true with Dollar Tree. But Walgreens is definitely a huge concern. Simply put, because Walgreens has already been closing a lot of stores around the US before the impact of tariffs. So exactly how bad is this situation for Realty Income? While we could really do a deep dive into each of these tenants, something that's actually quite a bit easier is simply looking at their credit ratings. And for Realty Income, we can see they actually have some of the best credit ratings out of all the real estate investment trusts out there. S&P Global gives them an A-, meaning stable. Moody's gives them A3, that's stable. The reality is that the credit ratings for Realty Income are still very, very good. And even in the midst of all this fear, you should still feel fairly confident in Realty Income. So even in the case that tariffs really played a major role in some of their top tenants, maybe dividend growth would slow down, but I wouldn't expect anything devastating like a dividend cut. And one of the things we also have to keep in mind is, even in the midst of tariffs, even in the midst of a potentially higher US 10-year treasury that's here to stay, Realty Income has performed very well from a total operational return standpoint since the REIT was listed publicly back in 1994. Now, what does total operational return actually mean in the case of Realty Income? Well, there's two things we're taking into account. Number one, the historical average dividend yield, which for Realty Income is about 6%, and then the historical average AFFO per share compounded annual growth rate. Now, in the case of REITs, AFFO per share is kind of similar to how we would look at earnings per share for most stocks. So in most cases, if AFFO per share is growing for a REIT, then they're growing their intrinsic value. So if we combine these two metrics, we can see the historical average total operational return for Realty Income is about 11%. So for example, they were able to do that during the dot-com burst. They were able to do it when the average 10-year treasury yield from 1996 to 2008 was 5%, quite a bit higher than it is right now. They did it during the housing market crash, great financial crisis, when risk of e-commerce was scaring a lot of REITs, and of course during COVID and the regional bank crisis. We have to keep in mind, it's extremely rare for a REIT to be able to grow its dividend payments for 27 consecutive years. And on top of this, something we always have to understand anytime we're looking at any type of investment, we have to look at it through the lens of a risk to reward ratio. Just as a very basic example, I'd much rather buy a stock that has maybe an 80% chance of growing its intrinsic value by about 8 to 9% every single year versus a stock that has about a 10% chance to double or a 90% chance to really not grow its intrinsic value. And in the case of Realty Income, the risk to reward ratio is actually very, very good, a lot better than a lot of people realize. Obviously, Realty Income is not going to grow its AFFO per share or its intrinsic value at as high of a rate of many companies will see in the S&P 500. But when you look at Realty Income compared to the risk you're taking on, the risk to reward ratio is very good. Down here, what we can see is the 10-year downside volatility, and over here to the left, we can see total operational return compounded annual growth rate since 2015. What we can see is the total operational returns for Realty Income is pretty decent. It's probably in the middle, somewhere average, above a lot of companies. But the 10-year downside volatility is essentially 0% for Realty Income. So from that standpoint, Realty Income is one of the least risky businesses to own. So again, from a risk to reward standpoint, Realty Income looks very attractive, which it makes sense why so many people are interested in that stock for that reason alone. Basically every year they are growing their intrinsic value. And so the end result of that, even though Realty Income hasn't outperformed in the last few years since they were listed publicly, the total return has way outperformed the S&P 500 in reality. Quite impressive. So the big question we need to answer now is, what do we think of Realty Income at its current valuation? Obviously year to date, up quite a bit, especially compared to the S&P 500. Well, to answer that question, let's go ahead and jump over to my REIT valuation spreadsheet and come up here and plug in stock ticker O. And you can see all this data will automatically load in. And like always, if you'd like to get access to any of my spreadsheets and also access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. There's currently a tariff sale going on. You can get 30% off any of the yearly plans by using code TARIFF. Now, the first valuation we want to look at is going to be our AFFO multiples valuation. Basically, what we're doing is we're looking at companies that are somewhat similar in structure to Realty Income and looking at that price to AFFO multiple. And we can see the average P to AFFO multiple for these companies is about 16.18, while Realty Income is sitting at 13.7. So if we applied the same price to AFFO to Realty Income, we'd come to an intrinsic value of $68.73, a decent bit higher than that current share price. Now, the next one we're going to look at is the historical FFO valuation. Basically, what we're doing is we're looking at how Realty Income has historically been valued. And to briefly summarize, if we come over here, we can see the average price to FFO over the last 10 years is 16.79. Right now, it's sitting at 14.48. So even if we look at how Realty Income has historically been valued, it's on the lower end of its valuation even after the run-up over the past few months. Finally, if we look at the dividend discount model, we're going to value Realty Income based on how much it's paying out in dividends and how that dividend has been growing over time. And if we assume a dividend growth rate for Realty Income of 3.25%, which, like we've already seen, is going to be a little bit lower than the historical dividend growth rates for this company from a 3, 5, and 10-year perspective, we still come to an intrinsic value of $63.33, about 8 to 9% higher than that current share price. So if we jump over to the Output tab and average the AFFO multiples in the dividend discount model together, we come to an intrinsic value of $66.03, which it looks like is about 12% higher than the current share price. So with a 10% margin of safety, the company is actually trading within a buy range, and with a 20% margin of safety, acceptable buy price of $52.82, and we've actually had multiple opportunities to buy the company within that range just in the last year. We can see at its low is about $52.47, and at one point last year as low as almost $51 a share. So yes, just like every stock out there right now, there are risks to Realty Income, especially with looming tariffs and what that could mean for the economy in general. But the reality is, especially from a risk to reward standpoint, Realty Income still looks like a decent opportunity, even from a valuation perspective. There are very, very few REITs out there that'll pay you monthly dividends, and that have been doing that for over 2 decades and have been growing that dividend on a quarterly basis above the rate of inflation as well. And even in the midst of the chaos, the credit rating agencies still seem to have favorable outlooks for Realty Income. So go ahead and let me know what you think of Realty Income in the comments down below if you plan on buying or selling. And like always, if you'd like to get access to any of my spreadsheets and access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com and use code TARIF to get 30% off any of the yearly plans. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.